Hello, and welcome back. I hope you had a nice weekend. In this video, I wanted to talk about Netflix because it is a company that has lately, I guess in the past week or so, has been enjoying a little bit of growth along with the rest of the stock market. But as it has fallen down about 73%, many people may be curious about potentially adding this one to their portfolio. They may be wondering whether it's a good opportunity right now. I mean, it has fallen off a cliff, right? It has fallen down a lot. So it may be a fantastic opportunity to buy right now. But I wanted to mention some points that you may not have thought about. And in this video, we're going to examine why I think that Netflix is actually not a good idea to invest in right now, and I will give you some concrete reasons on why this is the case. Now, of course, this doesn't only apply to Netflix. There are many other similar sort of companies that are not really worth investing in right now for similar reasons. And I'm pretty sure after watching this video, you will be able to deduce some of those, or most of those really, because of again similar reasons. Now, there are some important things about Netflix that we need to talk about. You can see here that the PE ratio, well, the PE ratio of the company is very solid here, and it's going down with the stock price going down. The price to free cash flow ratio has been going up and down quite significantly. That's because in some years the free cash flow was positive, in some years it was negative. It was actually mostly positive in the COVID years, where people were actually pretty much sitting at home watching movies and series. But it seems to be growing negative again. Again, it may be having some positive years or quarters. We'll see how it's going to do in the future, but that's not really the point here. What we want to examine is Netflix when compared to the current economic situation. Because remember, we are currently sitting in a high inflationary period. And why is that important, especially important for a company like Netflix? There are a few reasons. It's not just one reason. Now, the first thing is cost of capital. And Netflix, understandably, is a very capital-intensive company. They do require to spend a lot of capital up front. They have many expenses that get amortized through years because they are producing digital content, as you can understand. And so they have to spend a lot of money in order to create these shows and pretty much series and everything that they are creating. And so with the cost of capital being higher because interest rates are going higher, they're going to be suffering because of that. It's going to be more expensive for them to actually produce this kind of content that they're producing. So their expenses are going to go up regardless of what they are planning to do. Unless, they really suffer in quality and create worse products, which is going to affect them as well. Now, there is another very important reason that Netflix may not be a great investment right now. And it has to do with people, consumers, that's you and I. Overall, when inflation hits and we're amidst an inflationary environment, people tend to spend less, and they won't be cutting down on things like food, for example, or apparel or medicine, because these are important to survive. These are non-discretionary items, as we call them. But they will be cutting down, especially on things like subscriptions, which are not really required for everyday life. It's more of like a luxury item, and so a lot of people are actually going to be cutting down on those. And while we have already seen this reduction in the terms of subscription levels for Netflix, we may be seeing some more in the future. Again, if this current environment continues, which is probably going to continue for a little while. Now, I wanted to point out some things in terms of the actual report that I was taking a look at in terms of amortization here for Netflix. You will see this amortization of content assets makes up the majority of cost of revenues. So there are some other expenses, for example, with acquisition, licensing, and things of that sort. But as you can understand, amortization plays a very important role for these kinds of companies, as we have examined in the past and we have talked about as well. And you will see here that the increase in cost of revenues, you have been noticing an increase here, 62%, 61%, a little bit of a reduction here actually, but take a look at the previous years. And you will see that the increase in the cost of revenues as compared to the year 2020 was primarily due to a 1.4 million increase in content amortization relating to our existing and new content. So as you can understand, recent competition as well as pretty much many subscription services are rising again, increasing competition, more exclusive content, original content, pretty much. So cost of revenue has increased because of that. And the only reason why it has dropped to 58% here, you will see it's actually mentioned in the report here, is primarily due to delays in content releases due to the pandemic, which results in content amortization growing at a slower rate because it gets content gets amortized in specific periods of time, pretty much. And so this is very important to see here, and you can kind of already see that if you take a look at our financial statements here in our tool. If you take a look at the income statements, you can clearly see that the actual cost of revenue for the company has been growing tremendously from 7.6 billion. Take a look at this growth here, and especially 2020 and 2021. It has from 2019. Take a look at this one. It's like 6 more billion, almost like 5 more billion here, which was almost the exclusive amount of cost of revenue in 2017, plus 2 billion, I guess. But you will see that it has been growing tremendously over the years, and it keeps growing quite a lot, it looks like. And if you take a look at the cash flow statement, you will see that the vast majority of depreciation amortization in terms of these expenses is obviously added back as part of our free cash flow here, as part of our operating cash flow, I should say. And then it actually gets converted to free cash flow. And while the company did well in 2020 in terms of that, it looks like they're going into negative territory again in 2021 over here. And so this all have to be factored in when you are looking to invest in a company of this sort, again, because the capital that they need to be utilizing is tremendous, and also the content that they produce gets amortized quite a lot, and so they need to keep producing it. They are wasting a lot of money in terms of potential debt, for example, and also they are losing a lot of money just because of this amortization, and they don't seem to be getting to profitable territory, at least a sustaining profitable territory here, sustainable. And if you take a look at the balance sheet over here, you can see that the total assets of the company, the total liabilities, I should say, are sitting at almost 30 billion. And for a company that doesn't make any free cash flow, really, who is going to be funding these? It's going to be extra debt, or it's going to be extra issues being shared, potentially. So both of these situations are going to be scary for investors. And total debt means higher interest rates because, again, we are amidst inflation. And you can kind of already see that piling up here. And if the company dilutes shareholders, that's also terrible because the stock price will eventually be going down. You're going to be getting diluted, especially if they do that a lot. And so we're looking at a dire situation here, and I kind of struggle to find a way out unless we actually go back to the previous territory, the previous years where we had very low interest rates, the cost of capital was low. And even then, a company like Netflix can still keep losing significant chunks of money because of these losses that they have in terms of amortization, especially, and also competition, because there's tons of competition right now. And so I wanted to kind of make a video which was a little bit different than the usual, just to tell you a few things about what you should be looking at when you are looking to invest in a company, especially right now when we're looking at high inflation. You should be making sure that you are not actually investing in companies that require lots of debt, and also that at companies that have products that are considered discretionary, so that you don't really need to survive, really, and are sort of like small luxuries, really. And so these kinds of products can actually suffer potentially. Now, if companies have some competitive advantage, and Netflix does have that advantage, at least for now, they could still be doing well. But again, these kinds of expenses will remain, and in the vast pool of people that they are subscribed to their content, I'm pretty sure we're going to be seeing more leaving this, maybe over other streaming companies that are cheaper, for example, and can even be more competitive with content potentially. So This is why I wanted to talk about Netflix and kind of give you some ideas, because again, this can apply to all sorts of companies. I would argue the same thing for companies like Tesla, for example, right now, which are extremely cash intensive. They are cash hungry companies, and it's not the best time right now to be holding companies of that sort. Companies that require massive amounts of capital, because capital is getting more and more expensive. So thank you for watching the video, and I hope you enjoyed. Please remember to leave a like and subscribe if you did, and I'll see you in the next one. Bye bye.